What's going on, everybody? Welcome to another webinar where we get to really show you the path that the wealthy take, the path that the real estate investors that are crushing it take, but really the path that you should have already been taught. You know, I am so excited about being able to teach all of you these things, but you know what? I'm not a CPA. I'm not a tax expert, so I can only get you to a certain level. And then I got to give you that dumb disclaimer. I'm not a CPA. Please consult with your CPA and tax professional for further advice. And that's what I always say, because you know what? I'm not smart enough to know what I don't know. I just do what I've been taught to do. And that's what I share. And that's exactly what Greg shares. And, you know, we've got Matt and we've got Greg on here because the two are like two peas in a pod. You see, we got tax strategies coming straight from Matt, which we had him on our MSTV, our PMC 2-hour group coaching, and he just rocked the house. So we thought we'd do a special webinar where we have him just kind of do his CPA hocus pocus stuff he does and show you some really amazing strategies. And then what's the best part about this is some of these strategies you're going to hear require some money. And if you need some money, well, the best place to go is that $44 trillion pot of money called qualified retirement plans. Yeah, how many of you have a 401k? Let's just get a roll call in the chat right now. How many of you just put I or put 401k in the chat? How many of you have a 401k, a 403b, a 403b, 457, TSP, anything that is considered a retirement account? I'll bet you any money it's like 80, 90% of you. So why don't we get that money working for you a little bit more effectively? But with that being said, I'm going to shut my mouth and I'm going to turn this over to the expert, the master of disasters, starting with Mr. Matt from True Books. Welcome to the show, man.
Hey, thanks for having me. Okay, so yeah, we can dive right in, and then I'm going to share a slide deck. And I assume this probably won't be so much free form back and forth, right? So should I make my way through the slides and then we kind of do questions after?
Yeah, I think that's the best way. And, you know, folks, as you're, listening to Matt, just put your questions in the Q&A. We'll get to them at the end. And we've got Brandy on with us too. So if it's anything with self-directed IRAs or anything that would happen over on Greg's side, then she is here to answer, but we'll transition to that in just a bit.
All right, so we'll do a little bit of an intro to myself, but this topic will be on taxes and real estate. So I run a firm called True Books, and that's our lane. Our lane is tax strategy, not just tax preparation, right? Filing your taxes and things like that. All of that is needed, but we just consider that compliance work. Anybody's going to need a tax person for that. We like to focus on advising our clients and helping them strategize regarding their tax bill. A little bit about me. I am a CPA. That's my specialty, sort of claim to fame. I put dad on there because I am in the thick of being a dad right now. I have a 4-year-old and twin 2-year-olds, so they keep me super busy. My personal investment strategies are I'm a long-term real estate investor, so I just consistently grow that portfolio, and that's sort of my side hustle there. And then at the bottom, I just truly am a lover of money, of business and real estate. I've had a great time running this firm, growing it from myself to about 20 people now over the last 4 years. And my whole career has taken me through this money and sort of finance journey. That's what's brought me here. So we're going to go over one main strategy during this call, but I want to talk a little bit about taxes. I love that I saw somebody already drop in the comments that is a strategy to defer tax. Typically in life, you don't want to push off your problems, but in tax, that is a great thing that you can do, is just to simply defer your tax bill and sort of kick the can down the road. And so again, we'll talk about one main strategy. But again, if you have any questions as to how this strategy works or anything like that, usually I'll do more of a roundtable. But for something like this, I'll make my way through the presentation. And if you want to throw any questions to the chat, I'll be sure to hop over there and help address those too. First thing about taxes, right? There's a couple ways that you can go at taxes. And the first one is to permanently lower them or temporarily defer them, right? Here are a couple ways of how you would lower taxes. So these are through things like deductions, simply taking expenses. And then you have things like your primary home exclusion. So for those of you not familiar with that, is if you live in a primary residence for 2 of the last 5 years, you get a tax break there if you were to sell the property. $250,000 of gain avoided if you're single, $500,000 if you're married. So that is a way you can, again, permanently lower your tax bill there. You will not have to necessarily pay that back later if you were to defer it, as if you were to defer it. And then another thing here is like long-term and short-term capital gain rates. If I hold a stock for less than 12 months, I'm going to pay short-term rates. If I hold that for more than 12 months, I get to pay long-term rates, which are, again, preferential. So these are ways to actually lower your tax bill. These are the ones that we like to focus on first because you're going to get most bang for your buck. In the event you cannot lower your taxes, we like to defer your tax bill as well too. Kick that can down the road. A couple of ways you can do this is through, for example, a 1031 exchange. I'm sure a lot of you here have heard of that. That is simply you buy property A throughout a year or so, however many years that property is appreciated to, say, from $100,000 purchase price to $200,000. You could then sell that property, and instead of paying tax and realizing any of that gain, if you choose to just push all that money into a new investment of equal or greater value, then you won't have to pay any tax on that gain, and you get to roll it forward, and you can do this year over year. The next would be an installment sale. So if I'm going to sell a property, I have the choice of doing a, entire payment up front where I realize all of that gain up front, or I can take payments over time and almost do like a seller finance deal. And that, again, is a way to defer the tax bill. Because I don't receive all of that money up front when I sell that property, I don't have to pay all that tax up front. So that could be a good strategy as well. And my last one, since I'm a real estate guy, my favorite one, depreciation. This is how most people in the real estate space will realize all of these massive tax benefits because, funny enough, I like to use a car for this example. But depreciation is, for example, I walk into a car dealership and I buy a new Range Rover and I put no money down because they have a sweet deal. I could potentially write off that entire vehicle against my business income or whatever else I have going on as an expense when in reality, it costs me no cash out of pocket. So it's a very high leverage expense within your business or your portfolio. And depreciation, as you'll see here as we go through here, is the magical expense as to how this major tax strategy that we're going to go over is going to work. So, okay, so I've really put together somewhat of a small case study so we can see how this would play out for somebody in an average scenario. And this assumes this is after you purchase a property and get it listed. So what we are going to go over is what we call the short-term rental loophole, okay? And the first thing that we're going to go over is cost segregation, just so we can get an idea of what that is, okay? This pie chart on the left, I want you to think of when you buy a property. This is what most accountants, just sort of baseline accountants, will look at a property as. They will look at this as these two pieces are, this is land and this is, let's say, the building. Together, they make one purchase, obviously. When you buy this building or a building, you don't just get the building. You get everything underneath it as well and inside of it. Now, the pie chart on the right, you'll see that we have a couple extra sections that we've broken out now. And this is because we got what we call a cost segregation study. So all a cost segregation study is, even though I have PDF up there, is that's all it is. It's simply a file that you will get and just forward to your accountant, and they will utilize that to help your tax return and put together your tax return. But what it does is it breaks down the components of a building when you buy it. So on the left, you'll see that's simply you bought a building and you're going to allocate a piece to land and a piece to the actual building. But in reality, when you buy a building, I get the building, I get the land, and I also get the small assets within the building. So you'll see if I were to buy this room that I'm sitting in, I don't just get the structure itself and the land that it sits on. I also get the tables, the paint, the carpet, hardwood, fixtures, wiring, electrical, windows, all of that. And it's important that we identify the value of those assets because I can depreciate those faster than I can just the building. So this is where when you look at someone who classifies their building like this on the left, you're not going to get a large depreciation expense as if you were to do a cost segregation study. Because the key is every asset life, if we move here now, you'll see I've broken out this pie chart between 39-year property, and then you have land, which is, there's no years. You can't depreciate land. And then I have 5-year property down here as well as 15-year property. Any property or all property that is 20 years or less, I can bonus depreciate and take in year one. Now, last year we were in an environment with the tax code where we could take 100% of that. Now we're in an environment where we take 80. It's due to sunset down to 0. My 2 cents. Do I think it's going to go to 0? No, but we have to deal with what we're given with now. So in this case here, on a $500,000 property, you'll see that in this example, they broke down a building value of $284,000, land value of $150,000, personal property $56,000, land improvements of $10,000. You will not be able to do this, nor your accountant will. This is where the cost segregation study will come in and take a look at what you just bought and assign these values. And again, it's important that 5-year property, that's the small fixtures and furniture that is inside, the carpet, the paint, things like that, windows. And then 15-year property is maybe land improvements that were done around the building or around the structure that you just bought. You'll see here that if I were to run a depreciation expense on this model here, I would get maybe 10 grand, 8 to 10 grand, I think is what the math shakes out. Because all I would get is the entire building piece, which they wouldn't be breaking out these pieces here. And I would just get that divided by 39. I wouldn't be able to get this large expense in year one of about 60 grand. Okay. But for those of you wanting to run the math, it's basically the 66,000 times 0.8 and then plus the 284,000 divided by the 39. If you wanted to add that up, that's where we get the 60 from. So again, point of cost segregation, you're likely not going to use it anymore after you give it to your accountant, and it is to maximize your depreciation expense when you buy a building, commercial or residential, doesn't matter. Here are the facts of somebody in this case, okay? We have somebody that makes $90,000 on a W-2, okay? So maybe they're a department store manager, something like that, but in this case, they make $90,000 as a W-2. Here's where the importance of this is. They now have this building that they bought, and they're going to use it as a short-term rental. And in this case, use it for an average rental period of 7 days or less. Very important that it's 7 days or less, which we'll get into after this. I'm highlighting how the strategy works first. So after they have the W-2, they buy the property 7 days or less. They have to what we call materially participate, which for easy terms for IRS, that is having some sort of skin in the game. That is managing the property yourself. If it's an Airbnb, you're listing it, you're hiring the cleaners, you're dealing with the tenants, you're collecting the deposits, you're running the finances, you're doing all of that. You can't hire a property manager. You can't sit back and kick your feet up just yet when you're doing this strategy. And then the last piece is this rental loss of $56,000, which I'll show you how that's broken out. This is an average P&L for a property that, let's say, is a short-term rental. You have some rental income, some expenses down here, and you'll notice that if you have short-term rental real estate or even long-term rental real estate, you yourself put together P&Ls like this. You don't need to come up with this depreciation expense number down here, as your accountant will do that for you, but this is where that 60 grand is tying in. And this is the beauty of this strategy, because you'll notice here that if I were to back out this 60 grand, this property technically, right, at cash flow is about $3,900 a year, which is what we want. We're not going to buy a losing asset. But now on paper, this is exactly what we mean by paper losses. On paper, we're losing money because of the depreciation expense that we get to realize. And so this is where I like to have this plug of, yes, I'm a tax guy and a tax strategist, but I have a love for accounting first. I was an auditor prior to this. And so I say this and I highlight this because you can't do any of this strategy or advisory work if you can't get your books together or have your books together in a timely manner. So this is where I always like to say, it's a big no-no if you couldn't pull a report similar to this one here throughout the year. And again, if you can't, it means that you need bookkeeping. No matter what tax talk or any talk I have regarding taxes and tax strategy, it always comes back to the core premise of bookkeeping. So it is such a overlooked skill. And again, if you're not going to do it yourself, definitely do yourself a favor and hire somebody out of the gate to do it for you. You will be able to make much better decisions and honestly save a lot more money if you have a bookkeeper that's helping you. So again, the litmus test there, if we were to sit down and tax plan next week, could you come to me with some sort of report like this so that we could have a productive conversation? If that's a no, I urge you to get your books together, start looking at a bookkeeper, or if you do it yourself, just start catching those up. So once you have that report now, this is how this tax bill would shake out for this person on 90 grand. With the strategy, they're going to pay about $4,900 in tax because at the end of the day, they're taking the 90K that they made and netting it with that loss of 56. And so the tax bill, if they weren't using that strategy, would be a little under 20 grand, 19.4. And so of a savings of about 14,000. And then usually the question that I'll get after is like, could you have done this with another property and drove it, right, or driven even a further loss? And yes, you can. That is sometimes what clients will do. They'll buy enough properties to where it's just a simple math equation. How many assets do I need to generate or purchase so that I can drill down my tax bill, given the money that I'm making at whatever, business I'm doing? So that is essentially how that tax strategy will work. And then it brings us to so these are the two tests that you have to meet depending on which way you want to go in real estate. So the example that we just used was a short-term rental. And so the reason that you had to go this 7 days or less is because technically in the IRS's eyes, every dollar you make is either passive or non-passive, which I believe I have let's just go to this here. The example of passive is rental real estate or passive business investments. My best example is I have somebody who works at Tesla. They invested into a security company years ago and no longer play a material role in that business, but it kicks them off about $1 million a year of cash flow. That would be a passive income generator for that client. Non-passive is something like a W-2 or active business income. So as you saw in that case study, somebody made 90 grand at their day job, generated a $56,000 loss on this side, and then we're able to net those out. Why? Because technically real estate most of the time is passive. But what we're doing here is we're avoiding that rule by having it be a short-term rental and going less than 7 days. So some people say, well, wait, I don't want to do short-term rental real estate. I prefer long-term. Look at me. I do long-term real estate. The only kicker is if you want to go long-term, you will have to be what we call a real estate professional. And so that's hard for most people. I myself am a CPA that works in real estate. I will never be able to be considered a real estate professional doing that line of work. My wife, who is in corporate finance, never will be able to meet that criteria. So if we wanted to do this master strategy where we make money at our day jobs, buy real estate, and then have those losses net and bring down our income, we will have to go the short-term rental route, which is, again, this less than 7 days. Now, you'll see here that I have less than 30 as well, because some people say, well, wait, instead of doing less than 7, can I do a midterm rental? Yes, you can. The kicker here is if you do a midterm rental, which is greater than 7 but less than 30, you have to have what we call, or what the IRS calls, substantial service, significant personal services. Meaning you have to, instead of turning down, right, like let's say the service at an Airbnb at the beginning of every stay, you have to do it daily. You maybe have to have a chef on site, a vehicle that they can use, some sort of concierge service, something like that that will rise that level of activity to a business. Then you are able to what they call avoid those 469 passive activity loss rules, which is, again, this master plan of getting our losses to net with our income. You'll notice here that B on both of them is the same. And this is the one that always gets me, because on Instagram and TikTok, all of the advice out there, they always forget to include B, which is you also have to materially participate. There's technically 7 tests that you have to meet, but you have to meet one of them to what we call materially participate. And we'll go over those. I'll sort of go over the gold standard of what those are. But again, in order to make this work where you're going to make money at your day job and acquire real estate and get these losses to net against that income, you will have to follow one of these paths depending on which type of real estate you want to acquire. And so again, they both just come with their challenges. The last thing I'll mention here is real estate professionals. A lot of people think you have to get a realtor's license or something like that. That is not the case. There's 2 tests that you have to meet to be a real estate professional. And this is a and test, not an or. So the first one is you have to work more than 750 hours in the nature of real estate, in the business of real estate. If you're a W-2 employee, that will not count. If you're a W-2 employee, you technically have to own 5% of that business. Most of the time that doesn't work. So you could be a flipper, you can manage your own portfolio, you can be a developer, you can be a real estate agent, whatever. There's a lot of different trades and businesses that you can be in within real estate, but it has to be within real estate. So a lot of people come to us and they think, oh, I'm a real estate professional. I work at least 750 hours. Well, that's only the first test. The second test is you have to work more than 1/2 of your time, total work time, in the business of real estate. This is where most people fail. And this is where the IRS would get you and you will lose in tax court. For context, from my understanding still as of this recording, or I'm sorry, like this presentation, there's only one court case where someone has passed that. And it was a pilot that proved he didn't need to work 40 hours a week. And so still was able to meet these standards of being a real estate professional. From my understanding, it's the most heavily litigated tax code section there is too, because of the opportunity you can see of making all this money here in your business and netting them out via these losses of real estate, which again are paper losses because you're cash flowing the entire time. That's my sort of 2 cents there on the real estate professional status is, remember, it's an and test. You have to meet both. You can't just meet one. Now, okay, we went over passive and non-passive. And so now here's the strategy for STRs. the master plan, again, is to make money on this side in your non-passive category, your W-2, your business, whatever that is, and then you generate real estate losses. Real estate technically is passive by nature and definition of the IRS. But this is why we call this, and I call this the short-term rental loophole, is because I truly think it is a loophole, and I truly think it will go away because it's not the IRS's intent for this to go down this way. And so this is how we are able to avoid these rules, these 469 passive activity loss rules, and are able to net these losses with our income. If we see this definition here, it's the worst, it's tax jargon, but for the purposes of this paragraph E3, an activity involving the use of tangible property is not a rental activity for a taxable year if for such taxable year, the average period of customer use of the property is 7 days or less. And then it calls out such as an auto or boat rental. So this is how we are simply avoiding those rules or avoiding those 469 rules that usually would not allow us to net our losses with our income to bring down our tax bill, is because of these rules, but we're able to skirt those because of it being a short-term rental and why there's so much emphasis on it has to be 7 days or less. And then again, it mentions this average period of customer use of 30 days or less if there's significant personal services, which are those substantial services that again will likely eat at your cash flow because you have to do more now for the property. But again, ideally the outlay in cash flow that you have will help via the tax benefit that's going to come around is the idea. So P.S. I know that I'm throwing a ton at you guys right now, so feel free to, again, drop anything in the chat, right? And I'll be sure to address those after, and we can go into any sort of topics that you want to go to after. I think this honestly is near the end. Yep. So this is the last piece, material participation. And I bring this up is because, again, this is the one that everybody forgets. So let's say you run through that entire scenario. You make $100,000 on a W-2, you buy your first short-term rental, you put down 25 grand, it cash flows, you're listing it on Airbnb, but then you go out and you hire a property manager. That would completely blow this strategy because you wouldn't be able to meet this material participation test. Now, there's a lot of tests in the tax code, and in this case, there's 7 of them, but you only have to meet 1 of them. You don't have to meet all of them. And this is where we go. Our first one is this gold standard rule of 500 hours. You will have to hit 500 hours in the activity to be considered a material participant. But as you can imagine, you're very much likely not going to hit 500 hours in your first short-term rental. There just isn't that much work to do. Even with you buying the property, closing on the property, finding your tenants, furnishing the property, rehabbing it, some of it yourself, traveling to the property, setting up the finances for the property, all of this, you won't hit 500 hours. So we usually will default to test 2, which is 100 hours and more than anybody else. So you'll see there, this gets a little bit tricky that let's say you are going to hire somebody like a cleaning service to turn over the property for you. That's fine. But what's best now is you have them keep a time log for how much time they're spending. Very normal. We see it all the time. And you keep track of your time so that you know you're beating them in time. And you can meet this material participation test, which is, again, 100 hours and more than anybody else. The third test is a lot of people like to say, okay, well, substantially all. This is an easy one. We're just going to say that we do it all. But you'll notice the problem is the second you hire help in this activity, you're technically defaulted to test 2, which is now you having to compare your time to other people. Now, I only have 3 tests here out of the 7 because the 4 of them have never used, honestly, in my professional career. And it's because most of them have to do with if the activity for any of the 5 preceding, sort of 10-year kind of thing, which 99% of the time, this is a new activity for somebody, so there's no shot that they have to meet any of those prior tests. This is if maybe you had a rental property that now you're bringing online as a short-term rental, then those rules would apply to you, which again, I would say your advisor, whoever you work with, will explore all of those for you. But 99.99% of the time, clients are going to hit one of these 3 tests. And again, this would be enough to push you past that finish line, right? And I think I'll just end here is, this is why we call it a loophole, is because, again, I don't think this will be around long. This is purely a way for people who want to go into real estate, right? I'm not a fan of buying something just for the tax savings, but if you truly look at real estate as a good retirement vehicle, wealth building strategy, this is really something to consider because, as you saw, you have somebody making at 90, 100,000 up to the millions if they run a business, and can now have the ability to purchase real estate and put those dollars into real estate and therefore drive these losses And again, we've seen clients make north of $500,000 and completely drive their income down to zero and have no federal income tax because they purchased enough real estate. And that's almost the math equation that you're running is, hey, if I buy this property, what am I projected to cash flow and what are my projected tax savings? So now we look at deals now, even personally, right? You're looking at deals as to, hey, what are the tax savings here? Not just like my wealth building opportunities and my cash flow opportunities. So again, I know that was like that to me at least feels like a fire hose of information. And I wouldn't expect anybody here to leave and be able to recite this or think that, you can walk with this and know every step of it if it'll work for you. So if you are going into this space of short-term rentals or long-term rentals, you definitely need to work with an advisor. And so this is sort of my last 2 cents. A lot of people ask when they should hire a CPA or an advisor. And my quick answer is always, if you are self-employed, you need to start working with somebody that can look at your tax situation from a planning perspective. Definitely, because now the tax code is completely flipped upside down for you. There's no right answer to your return. You have deductions available to you and all of these different things. So it's if you're self-employed, and then if you own real estate, again, that's also a time where you need to sit down and maybe strategize about what you have going on instead of just going at it with a tax preparer. So, all right, that's what I got.
Good stuff.
Yeah.
All right. Well, there's been a bunch of questions coming in the chat, but if I could ask everybody to put your questions over in the Q&A, but let's start with Andrews here. Actually, you can see those, right?
Yep, I can. Yeah, here.
All right. So why don't we just rapid fire? We'll just go through them and I'll just let you take it from there.
Okay. So can you defer capital gains tax from a sale of a business? You used to be able to 1031 things other than real property, but since crypto came out, the IRS has gone back on that. And now they are strict to, you can only 1031 real estate, right? Real property. So could you do a 1031 of some type on the sale of a business? No. If it is an asset sale and you have assets within that business, then yes, you can potentially do a 1031. But my thoughts are you're going to have to worry about selling that business. You're going to have a tax gain, and then you'd have to strategize how to bring that gain down through other losses of where you invest the money would be my quick rapid fire answer there. Nicholas, can I just make a deal with a real estate agent? I'm not sure what you mean by that. Can I just make a deal?
I think maybe the hours, is that what you were looking at, Nicholas? Is like the amount of hours? Could you partner or make a deal with a realtor? We'll have to get clarification.
Hours. Just make a deal with the real estate agent. So that wouldn't get you your hours. So your hours for real estate professional status or material participation are hours that you yourself spend within those activities. So could you partner with a real estate agent to find you the deal and cut them a fee and maybe have them as a partner? Yes, but all of these hours and tests are up to the taxpayer themselves. One thing I forgot to mention with real estate professional status, if you have a spouse, we've seen it done all the time. If you have a spouse that maybe stay at home and they don't work, they could go out and earn that real estate professional status, and then the entire couple gets that. So that's a big strategy that we see a lot of people implement too.
Yeah, Matt, that's what me and Larissa did in the early days when I was still working as a financial advisor. That's what she did. She basically, got her realtor license and started doing real estate. And exact same strategy.
Great strategy. Okay, Boyd, what question would you ask to help you know if you are finding the right CPA and advisor for you? Okay, I got you here. What a lot of people don't ask potential CPAs is if they help clients within their specific business sector or industry or niche. So I think people need more confidence when they're interviewing a CPA, because at the end of the day, yes, we're here to work for you. And so while there is a massive shortage of CPAs and accountants right now, there's a ton more work for how many service providers there are. I think it's important that you grill and really ask a lot of questions to who you're about to potentially work with and ask them if they've helped clients that are in your similar situation. And again, for me, you need to ask it like, can you help me and sit down and strategize with me, not just prepare my taxes? There's a really big difference between that. And I'll tell you now, all the old heads, I'm 31 for context. My firm is very young. I'm really young for the profession. A lot of old accountants you go to them, they're going to prepare your taxes and they're going to send you your return and you're done. You may be able to ask them questions here or there, but they don't have a service where they're going to sit with you and strategize. So it's important that you get that out up front if that's what you're looking for, and you make sure that they'll give you that. Can you do this strategy on STR arbitrage? Really good question. No, because you need to own the asset. So if you are somehow on title for the asset, then you will get to take the depreciation. But if you're not, and you're just doing STR arbitrage, That is considered business income that you have. You're not going to get depreciation. So my answer there would be take the money that you're making from the arbitrage business, go purchase your own short-term rentals, utilize those as the losses to bring them down. That's what I would say there. Any advice on how to find a good CPA? Interview a few of them. I mean, look online, but it is find people who are in your industry. And here's another way. Ask people within your own industry, friends and colleagues of yours, who they use, and go to them. This is such a referral heavy business. I like to think this is true, but I have, for example, a coach that coaches me. His firm does a little bit more than we do. We're about 2 years trailing behind him. And he's basically said, once a firm reaches a certain level, they'll grow 30% year over year just on referrals without even doing outbound marketing. So knowing that, utilize your network and ask who they're using and find who you like would be my best answer there. Yes, the hours. Okay, we got you there. Could I have a business meet those hours? It's if you were the owner of the business potentially, then yes. Yes, you could. Justin, so how would you log hours this way? It's legit, or would it be as simple as writing it down in a log, or does it have to be tracked by someone else? Great question. We have a log. I would love to send it to Chris. Chris can disseminate that to the group. We have a log, and it has a little table to the right, same one we give our clients. It has a list of what hours count, what hours don't count, because then you really start to get into the IRS looks at hours and classifies hours in different buckets. There's investor level hours, there's education and research hours, and then there's actual operational hours. If you have a lot of education and research, like, oh, I was finding deals and I was networking and I was browsing properties, they don't like that. That doesn't have a material effect on the operation. The hours that they want to see that you utilize are ones like you're furnishing the property, you're meeting with tenants, you're collecting the deposits and the rent, all of those stuff that is integral to the operation. If I loan money, how is the best way to get around capital gains tax? So loaning money isn't going to generate you capital gains tax. It's going to generate you ordinary income. Loaning money and how to get around it, here's the quick answer. Find a way to be a partner in that deal so that you share on the upside for the capital gain when the deal sells. Now, that's a quick answer and needs a lot of context. I'll finish it with, if they're a flipper, you're not going to get any. There's no capital gains tax there because they treat that almost like the grocery store treats milk, right? That's just inventory. But if you're just going to do a one-off project and you're trying to deploy some capital into it, be a partner in that deal so that when the deal closes, that's capital gain coming back to you. Nicholas, can you determine depreciation before buying a property? Yes. Here is my back of the napkin calc, okay? Take the purchase price. If you can, break out the land. So for me, I always like to go conservative somewhat, but this will vary depending on where you are in the country. Multiply that purchase price times 0.7. That to me is going to give you a fair estimate of what the building value would be. From there, multiply that times 0.2, 20%. And that gives us roughly the assets that are the 20 years or less of what we can bonus depreciate. And then I hate to hit you again, but hit that number again times 0.8. That'll give you a rough depreciation expense for year one. So again, it's purchase price times 0.7 times 0.2 times 0.8. And that should give you a rough base for what depreciation is. But go to a cost seg study firm and they'll run a preliminary study for you if you just give them the address. So that's honestly what I would do there. Have them run a preliminary study and you'll know what the potential tax savings could be on that property before you even close on it. Okay, Stacy, when you define short-term rentals, you are referring to less than 7-day rentals that you can have 52 rentals less than 7 days a year. Technically, yes. So it's your average stay has to be less than 7 days. So if you take how many days it's been rented over how many bookings, that day, that number has to be 7 or less. So the average stay for a tenant has to be 7 or less. How about if 4 partners, not family, inside an LLC and buy an STR? How does it work? Okay, you're getting me here. So this is where remember the material participation test, right? Let's walk through this. You go out and you 4 partners buy a deal. None of you are going to hit 500 hours to materially participate in that deal. And let's look at that deal as its own pie. Each of you are going to get 25% for ease of math here. You want to utilize this loss. Let's say you each get $100,000 loss. I'm sorry, there's $100,000 loss. You break it off in 4 parts. You each get 25 grand. You want to utilize your 25 grand to net against your income. If you don't work 500 hours within the activity, you can't materially participate. So then we go to test 2. Well, what's test 2? 100 hours and more than anybody else. So all of you will be somewhat competing to use that loss or your own respective loss. So You could get into a sticky situation there to where only one of you will be able to materially participate. I have seen projects big enough to where people will hit the 500 hours. And that is because they're buying, a couple $1 million house in Scottsdale. And it takes a lot of activity. They're going out to the property, they're furnishing it, they're doing some rehab themselves. So not to say it can't work, but that's a situation that you definitely got to talk to somebody for a longer conversation about. Okay, Ben, if you have a business that's an S Corp and have to pay yourself a reasonable salary before taking distributions, does that categorize you as a W-2 and therefore unable to take advantage of this loophole? Not at all. So S Corps, yes, you have to take a reasonable salary if you work within the business. I like to say that that's the way that if I got paid on commission, I would definitely go work for the IRS because I would be ringing people for running S Corps, not taking salaries. Just because you're on a W-2 doesn't mean you can't take advantage of the loophole at all. It just means that you're still going to have to follow those rules of buying an STR, short-term rental, less than 7 days and materially participating. Then not only your W-2 income that comes from that S Corp, but your K-1 income, all of your income, you will likely be able to net out if you buy the real estate over here and follow those rules. So your S Corp makes 100, you paid yourself 50, you make 150, you buy 2 STRs, they drive you $100,000 loss, you bring that down, you pay tax on 50. So it's a win-win there. That's how that would work, Ben. Is there any benefit to establish a borrowing and lending business to take advantage of tax benefits for all of the borrowing and lending transactions I plan to do with IBC? Yes and no. Yes, if your frequency is going to be that of a level of a business, because then you get to take expenses. So a lot of people, when it comes to lending money, if you're just lending money on a couple deals here and there, you're just going to get hit with ordinary income. If you're like, man, I've been doing this for quite a while now and I want to take some expenses. This trip I'm about to take to Hawaii, I'd like to write off. I want to buy a laptop. I want to write off my cell phone. Sure. But if you start to take expenses, now you're not just hit with ordinary income, but you're hit with self-employment tax as well. So you just have to factor that in to see if it really makes sense and if you have enough deductions to bring down that tax bill given your activity. So yes, it could. And I hate to give that answer, but that's tax sometimes. It could. You have to run down that road a little bit more to see what's best for you. All right, that was the questions. Let me pop open the chat. Okay. Back of the napkin deals, baby. That's my thing. There we go. What tax advantages can I use if I do not own the real estate and I arbitrage a short-term rental? Tax advantages could you use? So the STR loophole could still work for you if you end up purchasing your own real estate. But other than that, though, you have S Corp available to you, right, with a reasonable wage, running your own solo 401k, self-directing that. You have a ton of opportunities just because you're running a business. And that's where we say the tax code is preferential to business owners. That's why I say there's that meme that goes around to where, oh, well, the IRS knows what you owe them. They really don't unless you're just a simple W-2 employee. The second you are self-employed, it is a whole new world for you. And that's where, William, I would take advantage of that, being that you're a business now. You're not just an employee. Okay, Kel, do you have any experience with car rental business with any of your clients? Yeah, so we have a lot of Turo businesses. It's funny, I lived by a guy who bought 80 Model Ys. I'll never forget that. Okay, that's it for the submitted ones.
And I think I just checked the chat. I pretty much got all the chats over into the Q&A. I was trying to direct traffic to keep us on time on that. But Matt, that was really good, man. And how did everybody like that? Put like in the chat if you liked what you just heard there. Because what we're going to do now is we're going to transition to the money side of it in the $44 trillion pool of money. And we're going to talk about control. So with that being said, Matt, thanks so much. And if any of you are interested, we'll put the link up there, how you can book a call with Matt. Anything in closing, Matt?
Appreciate you having me. Anytime. I'll be back. Tax is fun to talk about. It's a game. You just got to play it right.
I love it, bud. Thanks so much for being on.
Appreciate you. Thank you.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Absolutely. All right, folks, we're going to transition now. We're going to move it over to retirement. You know, if I ask everybody on here right now, why do you save money for retirement? Because a bunch of you said you had 401ks and everything. You know, is it because you want to retire someday? But what does that mean? What does that look like? You know, have you ever actually thought about what does retirement look like? You know, where are you going to live? What's your perfect day? What car are you going to drive? What house are you going to live in? Is it going to be on the beach? Is it not going to be? All these things come down to one common denominator, and that is how much income you're going to need to support that lifestyle, which is what I think is one of the biggest things missed in retirement. But that's what we're going to transition to. And we're going to talk about taking back control of your retirement dollars. Because you know what? Most people that put money in 401ks, 403bs, any retirement account, and they do it the traditional way, you gave up control of that money. That money's in control of whatever firm you're with. They're going to manage that money. They're going to direct that money. The 401k is going to do whatever they do, put it in whatever funds they give you options of having, and that's it. Somebody else is making money on your money while hopefully you make. But today, I got bad news for you. Did you see the markets? You lost today. And there's some crazy things going on. So I just can't think of a better time than right now, right on the brink, right off of the 52-week highs to look at making some shifts with your retirement accounts into some self-directed accounts. And that's what we got Greg Hurling. Welcome. And well, actually, I shouldn't say welcome, Greg. You're on this so often. You're just a regular contributor to this show.
Well, thanks for having me, Chris. And look, Matt, that was great. I am not like the way you explained cost seg was so good. So thank you for doing that. The example was great. And I mean, and I think the way you summed it up is like a perfect lead way into or segue into what we're talking about. And maybe that's why you did it. You were so smooth in your presentation. Truly it's not necessarily, I mean, what Matt just talked about, and then what Chris kind of led up to about using your retirement money is really about using the rules that are out there. The loopholes that are out there, they're all legal. We're not here to share with you anything that's illegal, but they're typically rules that you're just not aware of, and you're not applying to your business or your money or your, if it's your real estate deals. Like there's so many real estate deals I did back in my 20s and even in the early 30s. I did not do this. And I paid way too much probably to the IRS. Obviously I got smarter and I continued to do what I was doing, but just got smarter using the vehicles that the IRS allows us to do, using the rules they allow us to do, which I thought Matt did a great job of explaining. And I think the same thing goes here, Chris. The same situation goes as the whole idea with the self-directed conversation is, can we get the same kind of returns or gains that we're doing outside of our retirement account, inside of a retirement account? That's all. I'm not here to say you need to go out and make 20, 30% in your money, which you can do, which is great. But how about just start doing some of these, these investments and gains using your retirement money, but making consistent returns. So instead of being in the up and down of the stock market, what if you can just continually to compound your interest, right? Making profits on your profits every single year until you go to retire. So the biggest thing that I like to share is when self-directing. If you're one of those people that has an old retirement account, meaning an old 401k or a 457 or a 403b, some kind of retirement plan that you put money into that was with a previous employer, and you still have that account, you qualify most likely to self-direct, meaning you can move that money into a company like ours. We're a trust company that allows you to invest in what you know and what you understand. And you're in control of it. Now, the other people that qualify for this are people that have traditional accounts, Roth accounts, simple SEP IRAs. If you fall on that boat as well, or instead of, you also can move your funds and invest in different real estate deals. Now, I think opposite what Matt talked about as far as passive and active, I think that's your presentation was great as far as, and correct me if I'm wrong on this, but the point was you've got to be active on that side of investing to benefit from the cost seg and the tax write-off, correct? You got to be active.
Yes.
And on my side, on the retirement side, it's more passive. If you're going out to your property and you're managing it and you're cleaning it, that's a conflict. But if you're managing it and you're going out and finding the asset and you're investing in it with your IRA and you hire someone to clean it and manage it, that's totally acceptable. And so there's just two pots of kind of opportunities as far as tax savings and tax money. And you're now I get the loophole the title of this. For those of you that, have W-2 income or just income in general that Matt explained, and you're looking to pay the IRS less, you should buy real estate and get those tax write-offs, right? Cost seg, get the tax write-offs and pay less to the IRS. The other bucket of money that hopefully most of you have as well is a retirement account. And the one thing I see some people do is they get excited about whatever the deal is. Let's just say it's like, hey, I'm going to go buy a rental property or a Bitcoin or whatever it might be. And they're just sick of the stock market. and they don't know their options. So what they'll do is they'll cash out the retirement plan. They'll literally cash out, right? They'll cash it out. They'll pay the penalties and the taxes. And so maybe after you're done with that, your 100,000 turns into $60,000 or $70,000, and then they'll make the investment, which I think is probably one of the worst things you can do. You might be listening to this today and don't know, but you can be moving part of or all of your retirement funds from wherever it's at into a trust company like ours. And once it comes to us, we then help you with the decision you make. We're not a fiduciary. We're not ones that are going to say, you should invest in this deal or this deal. We're going to help you with the documentation. So once you pick that investment of what you want to invest in, we will help you with that process. And we help hundreds of new people every single month with the process of moving their money over, getting them established with us so they can start investing and getting consistent returns. I mean, Chris, this is how you and I probably met really, I don't know, how long ago was it now?
2014.
2014. Wow. All right. So, I mean, this is really how we met. And the reason why this is so near and dear to my heart, I think even someone commented in the chat early on when Matt was talking, it was like, or when Chris, maybe you introduced and said, who has an IRA? There was tons of you with retirement accounts, but there's a few that said, I'm broke, or I have nothing, or I have no retirement account set up. That's probably why this subject, the other side of it, has been so important to me. Is when I was 23 years old, my first deal, when I was broke and had nothing, somebody else from their retirement account lent me and partnered with me and funded my first deal. And so, Chris, when you mentioned there's trillions of dollars in retirement money out there, that's absolutely the case. So if you're in that boat of like, hey, look, I have no money, don't have a retirement account, but I want one, you can use or work with other people's IRAs to fund your first deal. And that's how that's kind of how the snowball effect starts. That's how I did my first 5 or 6 deals until I could open up my own retirement account. And then for the majority of you, or maybe the other half of you that are listening here, that have a simple SEP or Roth or an old 401k, and I keep saying old 401k because remember, for a refresher for some of you, you can't move a current 401k from your current employer. So if you are employed where you have a 401k, you can't self-direct that. It's got to stay there until you leave in that employment. But for those individuals that have those retirement accounts and are kind of sick of the stock market that Chris talked about, it's a very simple thing to do. Chris, I know you and your wife do it. Your IRAs will fund different projects for other people.
We're doing it right now, Greg. We literally just this week, your team is helping us, mine and Larissa's, pull our money together and lend on one of Chris Rude's deals. So we do it all the time. And, it's kind of funny, I'm ex-Wall Street guy, and I remember the ups, downs, and you're seeing it in the markets again. But like when I look at my 401k statement on the dashboard at Horizon, it's literally, and I'm not even kidding you, it's a straight line up. Not straight up, but it's just a nice transitioning smooth line. There are no bumps in it at all.
Yeah, and this is the disclaimer me. There's always risk, right? I mean, you can definitely have risk as you invest in whoever you invest with. But if typically what I've seen, because I'm a real estate investor, I love investing in what I know and understand. And if that's you and you love precious metals, I mean, I can't tell you recently, you probably appreciate this, Chris, more than anything, the traction on precious metals right now is it's gone like through the roof. People just want to be out of the stock market and want to invest in something more tangible, like precious metals, or businesses that they know, or partner in businesses that they know. So it's a fun place to be as well. So for me, self-directing, not only it's sexy because you're unlocking your retirement funds and using it in things that you know and understand, but it's things that you appreciate. In real estate, I like to say in stocks instead of, or rocks instead of stocks, and something tangible. So when the market changes, maybe it doesn't appreciate, or maybe even depreciates in a real estate asset you own in your IRA. There's still rental income, or there's still some kind of income typically in most of the stuff that you're buying. People wholesale it. And so I would say that's as far as the transition, because I know we don't have too much time. Chris, you tell me how much time we have, and we'll answer questions as well. This is more for the passive approach for those you individuals that are listening here that are looking not necessarily to save on taxes, but to defer taxes and invest in getting hopefully double-digit returns using their retirement account, self-directings for that. And I will say Brandy is on here. And so for those of you that want to learn and see if if you're not sure if your retirement account qualifies for what I'm talking about, Brandy can message you, or you can just put in your information here and get it with Chris, and we'll help you and talk to you about your retirement account, because every retirement account is pretty different. And it might, and we want to help you with where you're at personally. This strategy does not work for everybody. So we definitely want to qualify you first to make sure your account qualifies to self-direct.
I love that. One of the things that I think is really important is, and I'll just use a real example. I was talking to one of our clients that, our community members that we work with, and we were talking about self-directing, and she had a large account, and, she's like, oh, that sounds risky. I'm like, well, define risky, because she had a basket of investments in the stock market, which were all high risk. So I asked her to define risk, and she says she really couldn't define it. She just said, well, because I don't understand it, it's risky. And I don't know this self-directed IRA thing. I said, you see that thing you have right there at your broker, that IRA, it's identical. See that Roth IRA that you have there? It's identical. See that solo K you have there? It's identical. There is no difference. And she said, I'm confused. I said, no, there's no difference. The only difference is over there, you have to invest in things that they tell you to invest in, or the things that you have available to invest in, which are all stock market based. Over here, you can invest in pretty much the universe of things, including alternatives. And then I said, okay, so let's define risk. So you put money in the stock market right now at the all-time high, when we're literally right on the cliff of going over and heading back down the other side, where what I do is I lend money out with security being a piece of a house, like your house right there. And I just said to her, I said, your house, do you think that's a good asset that the bank has, when you had a mortgage, is that a good asset for the bank to have as security? And she said, absolutely. I said, well, I'm no different. I have a house that secures the loan I make. And then for some of the deals, I even get a personal guarantee, so that if they default, I can take the house, but then I'm going to go after their personal assets. So I said, where's the risk in that? And she says, well, I don't know. I said, would you realize you can lose everything in the stocks or mutual funds, or they can go down to zero, in the event of a bankruptcy. Can your house go to zero? And she said, absolutely not. I said, can it go down in value? She said, yeah. I said, how much? She said, I don't know, not much. I said, so that's your risk. But your risk really isn't even the valuation of the house going down. The risk is really just you not getting the payments. But if you get the personal, so I just defined like risk to her. And at the end, she's just like, okay, let's go. Let's do it. So I think a lot of people, when they say, oh, it's risky, it's really just because it's new to them. They're not used to doing that, or they think it's complicated. But your team does all the work. And I don't want to throw anyone on your team under the bus, but like when I do a deal, I'm busy. I don't have time. So I send the paperwork over to them, which is literally takes 30 seconds to fill the paperwork out, and they help me do the rest.
Yeah, no, we make it a simple process, and look, it is different, and so that's why it feels risky for, I think, most people. But look, I mean, almost today's cost seg, that's different. I mean, you bring that up to somebody new from the beginning, they'd be like, wait, that seems too good to be true. It's not. This has been around for a long time. So, similar but different. In this case, the financial brokerage world, the typical stock market world doesn't really want and encourage people to do this. Why? Because they don't get paid. The second reason why people don't do this is they shouldn't. And this is the cold, hard truth here is I'm not here to tell you that everybody should self-direct. In fact, probably at least 50 to 60% of Americans shouldn't self-direct. They work their 9-to-5 jobs. They don't want to put any attention and time and details into looking at any other investments and research and this piece of real estate or this contract or precious metals. This is not for them. But typically the people I'm speaking to are audiences that are business owners, people that are entrepreneurs, people that are looking to invest in something different than the stock market, create some kind of change. And so that is our audience. We're looking for that 10% of the US population that has a retirement account, that's sick of the returns, that wants to take a little bit of action. And when I say a little bit of action, again, this is passive. This doesn't mean that you're investing in something where you are, spending hundreds of hours per year on. In fact, you can't. Then that wouldn't be compliant. Something more passive where you might be spending a half an hour a month on it, maybe an hour a month at the most. But the reason why it's so powerful, and we've played around this compounding calculator so much, is if you just make a few little tweaks and you turn your retirement account into earning a consistent 10% rate of return, I'm not saying even 12%, but going from like negative return or maybe 6% on average to 10%, that 3 or 4% every single year you make your retirement account, 10 and 15 and 20 years from now is literally millions of dollars. We're talking about millions of dollars earning just an extra 3 or 4% per year. That's why this is so powerful. Because if you and I, Chris continues to, and let's say he invests outside of his IRA and I'm inside my IRA, investing in the exact same stuff. Let's just say we're lending. That's it. We're lending to real estate investors. We're each earning 10%, but Chris is doing it outside of his retirement account, lending. He's going to pay taxes on those gains, ordinary income. We just talked about it. I'm not going to pay anything. And when I don't pay anything and I make interest on my interest, compounding every single year, in 10, 15, 20 years, I would have literally millions more than Chris, and we're investing the exact same thing. So it really is about investing smarter, not harder. I noticed someone said that in the chat box earlier when Matt was talking. That truly is the case. Having the right people around you, having the right relationships around you, and using the right vehicles that have been around. Like what I'm talking about, it's been around since the 70s, since Chris and I were born. Definitely not since Matt's been born. It's been around for a long time. And so this is a real, a lot of people are using it. In fact, a lot of the wealthy are using it. The rich are getting richer. And so I just like that it's finally becoming a bigger message out in the US where people know that they can start using this.
Yeah, that is a cool thing. A lot more people now are getting used to, the word self-directed IRAs. The only problem is the big brokerages like Schwab, TD, and all them are starting to say, oh, we have self-directed IRAs. But
yes, they do.
They're not the same, but they're using the buzzword. Kudos to them. Marketing.
It's creative. That's good marketing. I mean, they say they have self-directed, which they do. They call it self-directed IRA, but then you get to go to their box and choose one of the 10 investments they have, and it's all, they're kind of fun. So it's interesting.
And I know we're a little over, but I think, one thing that Melanie brought up in the chat that we never really cover in depth is, checkbook control. That's a really popular thing. And I think it's because the control piece of it. Can you just hit checkbook control? And, I know you guys do that, but just hit it and explain it.
Yeah, for sure. Look, Checkbook LLCs is like the sexy thing out there. It's one of the hot topics in marketing. And frankly, I would steal a slide out of Matt's presentation where he talked about the importance of bookkeeping. Checkbook LLCs is if you're an individual that has multiple transactions that you want to do with your retirement account. Let me give you an example. Actually, let me back up. Let's just say that I want to fix and flip a property with my IRA, or I want to buy a rental property with it, right? Well, buying it and closing on title is one thing, but then let's say that every month I have to pay a property manager, I got to pay utilities. Well, every time you got to write a check out for one of those things from your IRA, you've got to send a form to my company saying, Horizon Trust, please, out of my IRA, send the property manager or send whatever for the furnace $1,000. Here's the invoice. You could see why that could be a pain in the ass. So instead of doing that, individuals that are savvy and that do their bookkeeping, do it accurately, will have us, they'll set up a Checkbook LLC and they will roll over, they'll fund their account with us, they'll move their IRA over to Horizon Trust. Then Horizon Trust will be the owner of an LLC. In that LLC, you are the manager of. So in this example, I'm going to pick on Matt because he's still here with us. Matt sets up an LLC that's owned by his Horizon Trust Company IRA. So it is the member and owner, but Matt is the manager of it. So Matt, as the manager of this LLC, can go out and look at investments, can choose those investments. But what Matt can't do is take a management fee, can't take a W-2, can't take a commission, can't take a realtor commission. So that's why sometimes I don't get too excited about it, because I'm worried that someone novice is coming in, doesn't do their bookkeeping right, all of a sudden is paying personal expenses, and that will blow up your retirement plan. I would say that we have literally, I don't know if it's thousands, but over 1,000 people that have the Checkbook LLC with our company that use it day in and day out, and they love it. Because now, if you want to go down to, let's say you want to go buy a property down at the courthouse, it's your LLC. So you can go down with the check from your LLC and buy an asset. And so it's very, very powerful. What I like to say as far as management goes, as far as the passiveness goes, is you can go out and look at properties. You can go look at investments, but you can't be the one digging the holes. So if you're manually labored and then all of a sudden there's a taxable event. And so checkbook LLCs are sexy. They're exciting, but you got to do your bookkeeping. So I'm still conservative about making sure you do it right. And if you're not sure about how to do it right, we can help you. I know Chris and your team can help as well, but we'll kind of help you with those loopholes of making sure you don't make any mistakes. Again, all this comes back to setting an appointment. If you have a retirement account and you want to learn how to use it, and if you want to do the checkbook LLC, because that sounds exciting, we'll teach you how to do that. If you just want to roll over, I would say 80% of our clients just roll over a portion of or all of the retirement account to us. You don't have to do all of it. You can do part of it. And then they'll use that to purchase or invest in a note or in a real estate deal themselves. Again, if you do a call with us, we'll kind of help you with what kind of account's right for you. If you're really engaged in your retirement account and you want to do the checkbook LLC, you absolutely can do it. It makes a lot of sense when you got a lot of transactions.
One of the things that you just mentioned there brought me back to my old days of when me and Larissa were buying a lot of houses at the auction. We'd go down to the Buffalo courthouse. There's this little table, we called it the alcove. And, you'd have to have cash there to buy the property. Like if you buy it, you're paying for it right there. And you just said that, like with the checkbook IRA, that would give you a whole nother way to do that type of transaction. I never thought about that. So
you probably, I didn't want to tell you about it back then, because I don't know if your bookkeeping was up to par. No, I'm joking.
It wasn't, believe me. But today I think I could pull that off with.
Yeah, you could pull it off today.
Yeah, for sure. So that was good stuff. So this, I know Brandy's been just rifling through the questions. I mean, I'm seeing them pop in and then they're popping out. So I think we knocked it out of the park there. Did everybody learn something today? I mean, whether it was short-term rentals, cost seg, about your 401k and how you can take back control. I mean, was this worth it, folks? A lot of you are asking about the replay. Will it be sent out? So what we do with these is we will edit this and it will go up on my YouTube channel, which is at the Chris Naugle. And you guys can all go back, watch it, see the replays, and it'll be there, well, in perpetuity. So enjoy that. But with that being said, I know we went over time. So Matt and Greg and Brandy, thank you so very much for joining us on this webinar. And the biggest thank you I got is to all of you on here. We had over 200 people at one point. So 200 thank yous and 200 hats off to every single one of you for joining us for this webinar and going out on a limb to learn something new so that you and your family can live the life you want. Thank you, and we'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.